At 9:15 every morning, thousands of people enter the same market, but they are not playing the same game. A mutual fund may be investing for years. A foreign fund may be comparing India with every other market. A proprietary desk may react in milliseconds, and an individual may be building wealth or trading the next 5 minutes. So, who really moves the Indian stock market? The useful answer begins with three things: capital, urgency, and liquidity. Capital tells us who has money committed. Urgency tells us who needs to trade now. Liquidity tells us how easily that trade can happen without moving the price. Promoters own roughly half the value of NSE-listed companies. Their edge is control, business knowledge, and a long horizon. Their constraint is concentrated, relatively illiquid wealth, along with strict disclosure, takeover, and insider trading rules. They shape companies, but usually do not dominate everyday trading. Among public investors, domestic institutions and foreign portfolio investors are the largest pools. Individuals also own shares directly and through mutual funds. The ownership chart gives the exact detail. You do not need to memorize every number. The pattern matters. Strategic and long horizon capital owns much of the market, and that pattern has been changing. Domestic mutual fund ownership reached a new high in March 2026. Foreign portfolio ownership fell to a 17-year low. By then, domestic institutions had held a larger share than foreign investors for 6 consecutive quarters, a balance last seen more than 2 decades ago. NSE's registered investor base also crossed 13 crore, more than 4 times its FY20 level. Direct individual ownership had eased, but household exposure through direct shares and mutual funds remained near a long-term high. The shift is not simply more retail trading. Household participation has broadened, and more of that capital is also being pooled and professionally managed. Now look at trading activity, and the picture changes. Proprietary firms and individuals together generated roughly 2/3 of cash market turnover in May. In index options, their combined share was close to 9/10 of premium turnover. That does not make them owners of 9/10 of the risk or winners of 9/10 of the profit. Ownership gives capacity to matter over time. Trading flow creates pressure now. To understand that pressure, we need to understand each player's edge and constraint. Mutual funds have professional research, diversification, and recurring household flows. But scheme mandates, redemptions, benchmarks, and the market impact of large orders limit their freedom. They may absorb selling when they see value, but are not automatic buyers at every price. Insurers and pension funds benefit from patient capital. Their constraint is their purpose, meeting future policyholder and retirement liabilities within strict allocation and risk rules. Foreign portfolio investors bring scale, global research, and sophisticated hedging. But the rupee, global rates, client withdrawals, and relative valuations can change their India allocation quickly. A large order can also be difficult to execute without moving prices. Proprietary and quantitative firms benefit from speed, technology, and flexible mandates. Their risks are leverage, funding pressure, model failure, and crowded trades. Some provide liquidity, others trade direction, arbitrage, or volatility. A market maker is a specialized liquidity provider, not another name for every proprietary trader. Pricing and hedging infrastructure can earn repeated spreads, but inventory and adverse selection risk can become dangerous when the world changes suddenly. Individuals are the most diverse group: investors, hedgers, active traders, learners, and speculators. Their advantage is flexibility and small size. Their vulnerabilities can include weaker information, execution costs, behavioral mistakes, and leverage. The common legal baseline is simple: no manipulation, false markets, or misuse of prohibited inside information. Regulated entities carry additional duties. This brings us to the most visible tug-of-war in Indian markets: foreign selling versus domestic buying. Through mid-June, NSE data showed substantial foreign outflows, while domestic institutions remained persistent net buyers. Mutual fund ownership had already reached a record, and monthly SIP contributions remained above 31,000 crore rupees in June. This domestic bid has absorbed part of the foreign selling and made the market less dependent on one source of capital. But it is a cushion, not a guarantee. It cannot make valuation irrelevant, remove geopolitical risk, or promise a floor under prices. Why have foreign investors had reasons to be cautious? The pressure has come from a combination, not one clean cause. The rupee weakened sharply during the last financial year. Higher global rates and a stronger dollar made emerging market capital less comfortable. The West Asia conflict then produced an acute oil shock in early 2026, especially difficult for a country that imports most of the crude it consumes. Valuation mattered too. Even after correcting from earlier extremes, Indian equities remained above their long-term forward valuation and at a sizable premium to emerging market peers in May. That does not predict a fall. It leaves less room for disappointment. The pressure also differs across sectors. Indian IT underperformed the broader market sharply over the year to June. It is tempting to say AI is hurting IT. The evidence is more interesting. Global clients remain cautious about discretionary spending. AI is improving productivity and moving contracts from billing for effort toward billing for outcomes, pressuring the old revenue model. But it is also creating projects and revenue. Investors are deciding which effect arrives first. This is why macro forces do not move every participant or sector in the same way. They change incentives, urgency, and the price investors will pay. Now imagine a sudden global shock. Some investors want less risk immediately. Others may see value but not at the old price. Liquidity providers adjust their quotes as uncertainty rises. If urgent selling exceeds the bids available, price falls until enough buyers appear. If urgent buying overwhelms the offers, price rises until enough sellers appear. The same order can barely move a deep, calm market and move a nervous, thin market sharply. Its impact depends on the liquidity waiting on the other side. So when you hear that FIIs moved the market, DIIs supported it, or retail drove options, ask 3 questions. Is the evidence about ownership, trading activity, or verified net flow? Is it about cash, futures, or options? And does it establish cause or offer a plausible story after the event? The framework to remember is simple: capital, urgency, and liquidity. In the next episode, we will apply it to options. We will explain why market makers hedge, what long and short gamma mean, and why that hedging can sometimes absorb a move and sometimes accelerate it. Behind every market move, there is method, some madness, and a model trying to make sense of both.